The best is yet to come. That's a great intro, Vikram. Thank you very much. So now we are coming to the probably most interesting part for you, the Q&A panel. I'm happy to have all our presenters here live in the room with us. And Vikram is joining us remotely. And we also have Amr Sunna joining us from Iraq. You're familiar with all the bios already. One new addition to the panel is our head of M&A, merger and acquisition, Thomas Shevani. He has more than 20 years experience in the industry. More than half of that within the Ooredoo group. He previously has held senior commercial positions here in Doha, but also has been the head of strategy in Indonesia and the last few years heading up our M&A activities for the group. Thanks for the questions received so far. We're going to do a mix of audio and chat questions. And let me start with the first questions that we got in the Q&A section here in Zoom. Feel free to type any more. I'm just going to read this one out. Regarding the new transaction of the tower company, what is the impacted cash flow immediately or as soon as the transaction materializes? And we get questions, when does the transaction materialize as well? And also looking forward, what's the net impact on the recurring EBITDA on consolidated level of Ooredoo and the expected impact on the net leverage for 2024 based on the tower transaction?
Sure, take it. That's a lot of questions in one go, but we'll try to take them first. Let's talk about what is the impact and when does the transaction close. We will have zero impact as long as the transaction is not closed. As explained in René's presentation, it's a staggered close. So we will close market after market. Our priorities is to close Qatar first in combination with Zain's Iraq and Jordan, then our Iraq footprint, and then try to close the remaining market. Our ambition is to close all markets within the next 12 to 18 months. Again, there is no immediate impact as long as we don't close markets. On EBITDA, assuming all markets are closed, the impact on the group's EBITDA is very marginal. The impact on leverage, actually, we will still be post-transaction, and if you take into account all operating leases, we will still be below or at the very, very low end of our guidance of 1.5 times net debt to EBITDA. We will, just as a reminder, we're 0.9 times right now. As we gradually close the markets, we will probably ramp up progressively between 1.2 to 1.5 times net debt to EBITDA. Free cash flows, different. There is first, as we close transaction, initially there's equalization with assets and shares from Zain and Task. As the value of our portfolio is significantly larger than the value of Zain, just not only in terms of towers, then we will have cash equalization payments. As these markets close, we will then get the proceeds from these cash equalization payments. We'll, of course, have to pay off tax friction costs and some minority interest we have in each operations. On a recurrent basis, there will be a free cash flow impact in terms of leases paid to the towerco. But to remind you, we will own on the other side close to 49.3% of the towerco, so we will benefit from 50% of these cash flows on our footprint, but also on the footprint added by Zain and Task.
Great, thank you very much. Let's take an audio question. The next question comes from Bahrain, from Nishit Lahotia from the Seco Securities. Nishit, you should be open now.
Yes, can you hear me?
Yes, we can hear you.
Okay, thanks. Again, it's a very detailed presentation, but my question again is on the most important transaction that's going on. So what I understand, I mean, from what's been said is that so for 12 to 18 months, this transaction will not fully close. So till then, this JV will not be showing on your say 18 months it takes. So for 18 months, there won't be any TowerCo JV accounting.
No. So from the first close, we have to close every single market independently. We'd rather close them all at once, but we have different regulatory process, and it's the complexity of doing a multi-footprint transaction all in one go. We have to get regulatory approval in each of the markets we operate in. We're hoping to close the first market within the first couple of markets within the first half of next year. The moment the first market closed, the JV is materialized on our balance sheets, on our books, and it's substantiated progressively as we close every market one after the other.
Okay, so carrying on from that, if we look at the entire transaction, your valuation is 1.7 billion. The entire entity valuation is 2.2 billion. 50% is 1.1 billion approximately. So you in net you are assuming a cash utilization between 550 to 600 million, leaving the minority part aside. Is that how I should look at the number over the next 18 months?
That's a very accurate math. There will be some slight variation to these numbers, as you can imagine, whether us in each of our opcos, also our partners in Zain, we don't stop rolling out networks. So these numbers are currently based on the planned rollout. If either we roll out slightly slower, slightly faster, there's some marginal, and I really stress, some very marginal adjustments at each closing to balance the number of existing assets, et cetera, et cetera. But your math are correct.
Okay, so in terms of the profitability booked, I mean, your carrying value was hardly anything of these, I mean, tower versus the, now that it's a JV accounting, there would be some gain that would be booked once these tower cos starts moving out as the transaction in each country close. So what would be the overall profits that would be booked over 18 months in P&L?
Yes, you want to take this one?
I think, as we said before, will be announced market by market, and we'll disclose it only when we close that market. Too early to assess this number now.
Okay, fine. I'll come back in the queue. That's it for now. Thank you so much.
Thank you.
Thank you very much, Nishit. And then we got a type question here from Alexei Filipov, fintech question. Oh, sorry. Next question. Yeah, it's with regards to our fintech operations, what would be the primary source of revenue earnings? Is it mostly driven by money remittance fees and B2B charges? Are you considering to expand into lending business? Mirko, maybe that's a question for you.
Yeah, excellent. Thanks, Andreas. So our revenue sources will be varied across a number of products and services that we will provide. In some markets, we are a greenfield operator, so we will start with the minimum viable product. In those markets, yes, remittances will be the first services we will provide, but we will very soon complement it with other services like bill payment, utility payment, cards. And then later on, we will enter into areas like salary disbursement, as well as lending. We will start with the micro lending. Imagine use cases like salary advances. So somebody receives on a monthly basis the salary paid on the app. We can provide an advance when we know there is a regular payment coming for that particular user. So in a nutshell, we will start with remittances. We will then expand, so the revenue sources will be varied. I think a very important point when we talk about areas like lending, we are, one of the principles I mentioned in the presentation is we are an ecosystem. So we will not carry loans in our balance sheet. We will partner with providers that will provide the capital and will take the risk, the risk of default. So in a nutshell, yes, there will be lending. It will be a capital light model on our side. And I'm pleased also to report that some discussions regarding the partnerships in this area have already started.
Great. Thank you very much.
Thank you.
Let's take another live question and let's go to Egypt. The next question comes from Omar Maha from EFG. Omar, ازيك يا معلم عامل ايه؟ Your line should be
أهلا. أهلا سهلا سامعني؟
Please go
Hello.
ahead.
Yes.
Yeah, we hear you, Omar.
Hi everyone. Thank you very much for the detailed presentation. Couple of questions from my end on the tower transaction again. So, first one is what kind of tenancy ratio do you aim to reach in the next 5 years? And the second one is perhaps if you could talk a little bit more about what the long-term game here is for the tower transaction. So I guess this is probably the first step to basically merge the towers, sort of like create the separate entity, the JV, and then what would the next step be, or the long term? Are you looking at perhaps listing this as a separate entity, or maybe spin it off and bring in a large strategic investor to further monetize that business, or even would you look at expanding that business, maybe merging or acquiring other similar businesses in the Middle East and Africa?
I'll start with the latter part of the questions. Sorry. I'll start with the latter part of the question is what's the plan, what's the focus for the next 18 to 24 months? For the next 18 to 24 months, our main focus is first closing and integrating our businesses. There is a lot of value still trapped within the tower businesses. I'll give you an example. This is part of our selection of Zain. First, we know Zain very well. They're a competitor, they're a respected competitor, but we overlap in a number of footprints. They're contributing their Iraqi assets, we're contributing our Iraqi assets. We also have overlap footprints in Kuwait, might be a subsequent step. There is a lot of trapped value. As you know, for a TowerCo, the number one cost are actually the land leases. For a telco, if we respectively look at our telcos, the number one cost is operating costs, which are divided by the number of tenants. So a rationalization of our tower portfolio, which now would be unlocked because it's independent management, it's jointly owned, it's neutral, we'll be able to unlock this. This will increase significantly the yield per assets for the towers, reduce actually the operating costs for the opcos, and technically result in a higher tenancy. Today, we're starting with a very low tenancy base, I think 1.05, and we're looking to go up within the medium term to industry average, which is, I think, 1.78 or something like this. Around that. This is the first step. The second step, you clearly, and I've stressed on it on my presentation, Renee as well, this is a clean vehicle. There is no leverage from day one. It's an annuity business. It's a very healthy vehicle, and it is from inception, when all markets are closed already, the market-leading TowerCo in the MENA region. I personally believe, and I think everyone around the table and our partners, that holistically in the region over the next 3 to 5 year horizon, the market will consolidate with probably 2 players at most, 2 major players at most. We will be one of those. We hope to be the leading one. We want to first extract the synergies. Then we have a clean balance sheet. We can leverage up. We can do further acquisition. This leverage can also help us fund CapEx expansion for these towers. And over time, of course, if you look at our strategy, portfolio strategy, these are part of the assets where we want to remain as a minority stake. Once we believe that we've unlocked significant value in synergies and in growth, at that time, we'll probably monetize partially the remainders of our stakes. But that's down the line.
That's very clear. Thank you. Thank you, Aziz. And maybe just one follow-up question from Enda, going back to the comment that you made about, I guess, the breakup valuation. I think what you mentioned is that once you sort of like crystallize the value of all those verticals that are being carved out, then you're left with an entity that's trading at like 3x EBITDA, as opposed to something in the range of or closer to 6x for a telco X all of these business. But my question here is don't you think perhaps the market, once you strip out all these growth verticals, and you're left with the core telco business, which is a very mature business, that the market would essentially assign a significantly lower valuation multiple to that entity, as opposed to the 5-6x that you mentioned?
No, well, actually, I would beg to differ because we're not stripping out, first of all. We're carving out, again, we're 49% shareholder in the TowerCo for the foreseeable future. Data Center Co, we will be a majority shareholder and a consolidator. FinTech, we're a consolidator, and Subsea Cable also, we will be a majority shareholder and consolidator. So we're just separating the balance sheets because I think we can have a better efficient capital structure, leveraging each of these segments on their independent business model, annuity, and stable yields perspective, and at the same time their own merits than just leveraging at the whole co. At the same time, maybe benefiting from the whole co effect and a very strong credit rating. But look at European, we are still in high growth markets. Most of our markets, if you look at our subscriber base, are still very young population, prepaid markets, very slowly merging to postpaid, underpenetrated in terms of mobile financial services, credit cards, fiber. So there's still a lot of growth left in the engine. At the same time, if you look at all the mature operators in Europe, in parts of Asia, they've already stripped out everything. You're even seeing operators in Europe right now, in Southern Europe, they're selling their active network, they're selling their fiber backbone, they're doing netcos, and they're still valued at 5 or 6x. So, whichever way you want to cut it, we're significantly undervalued. Did I convince you on that one?
To a certain extent. But thank you. I appreciate the comments. Very insightful. Thanks.
Thank you very much, Omar. Then we got another question here in the Q&A section with regards to the data center business. It's going to be one of the verticals that you're planning to spin off and establish. How is the cooperation with Misa going forward? Will you cooperate with them? What's the outlook there?
So with Misa this year, we participated and supported them in their IPO. We have monetized half of our share. We're now just a financial investor. It is healthy for any given market to have at least 2 providers of data centers. You need redundant facilities. Hyperscalers, clients require diversification in their supply. So it is important for us to have another player in the market. But between a commercial cooperation between Ooredoo and Misa is completely as our arm's length. We see them more as a competitor. We retain a 10% stake, which is a small minority. We have a lockup. Once our lockup expires, and depending on the market performance, etc., then we'll review our options.
Great. Thank you very much. Let's take another live question. Usman Akram, if you could ask your question, please. Need to unmute. Okay, if the question is not there, then we take another one from the Q&A here. Pradyuma Mishra is asking about Ooredoo's growth outlook. Can you get back into a high single-digit scenario on a revenue level? And what would need to happen to get there?
So look, we've always been relatively conservative on our outlooks. We're in the low single digits. We have some markets which are growing in the high single digits, namely currently Iraq and Algeria. On a combined basis, they represent, I think, something close to 30% of our EBITDA. So we have pools of growth. We also have Indosat, which is growing very fast. Again, to my previous comment during the presentation, is the value proposition of Ooredoo is a combined portfolio between mature, high investment grade with very stable political, currency, and economic risk, which represent basically roughly 50% of the EBITDA contribution, a bit more, and then a pool of related markets, which are emerging markets with a much higher growth profile, but also slightly more volatility in terms of currency and economic situation. Even if these markets are growing in a high single-digit factor, our mature markets are on their side growing at very, very low single-digit. That gives a blended growth usually in the low to mid single-digit growth. I would love to grow at 9-10%, but maybe just one point. We're here extremely focused on EBITDA growth more than revenue growth. Growing revenues is very easy. If these revenues translate in very low margin businesses, then we actually deteriorate the profitability of the business. So we've always kept that very strong focus on good revenues versus revenues at all cost.
And then from the same investor question, the tower lease split in terms of currencies, what's the split between USD and local currencies?
Yeah. So part of this transaction was at the same time, again, we're not trying to create a tower co because we needed to maximize value of day one and to deleverage or generate a maximum amount of cash. We're trying to build a sustainable leader in the infrastructure replace. At the same time, try to get a very balanced view for both our telco operation and the tower co. We're trying really both, and we shared, this was one of the reasons we selected the Zain and Task, is we shared the same optics on that. So all of our leases are actually in local currency. That being said, majority of the operation have pegged currency, therefore there's limited currency risks.
And his last question is, what other M&A plans do we have? M&A question.
So I get this question all the time. Same answer I probably gave in the last few calls. We remain extremely opportunistic. We've done very small M&A acquisitions in each of our footprints because we believe that in-footprint acquisitions actually generate the most value. These are small transactions. Typically, we bought a small ISP in Iraq. We're looking at different things. These are ancillary value accretive for independent operation. As a group, we've been very disciplined. We're reviewing constantly all the opportunities. The strong benefit we have today versus 18 to 24 months ago. 24 months ago, our core M&A targets were telcos. We could only look at out-of-footprint telcos as a vertical start because Ooredoo was a pure telco payer. Today, going forward, you have telco, data center, tower co, subsea co, maybe eventually, and MFS. For each of these verticals, we now have optionality to acquire independently out of footprint in these independent verticals. So technically, we might remain a telco within our existing footprint, but expand our data centers, for instance, in some of the neighboring countries or North African countries. Someone even mentioned sub-Saharan countries. Similarly, towers, they might have a footprint in 5 years, which is mostly decorrelated from our own existing footprint. Our existing footprint served to incept these vehicles with initial structure, substance, and capital. But then each of these verticals will chase growth, inorganic growth in where we see the most value and where is the most relevant. So now we have a much broader view of optionality in terms of M&A.
Excellent. Thank you very much. Then there's one more question with regards to our net debt to EBITDA ratio. Why are you going to increase from 0.9 to 1.5 in the future?
So that's just pure accounting treatment. We're not borrowing more. In the moment you do a tower co, you actually have long-term leases, which from IFRS perspective are treated as these are long-term commitments in a similar manner as debt. So we're not borrowing more. It's just that as we close the markets, we sell our towers, we lease them back, and these leases will be captured as operating leases and therefore calculated in the net debt. So it's just an accounting metrics.
All right. Then we got a question on the Indonesian market. I'm going to try to open up the microphone for Vikram. The question is, what has been the key for the integration happening faster than expectations?
Hi, Andreas. Can you hear me?
Excellent. We can hear you. Vikram, go ahead, please.
No, I think thanks for this question. Let me say that our purpose, was to ensure that every site level we ensure better experience, because customer don't care merger, no merger. What they care is how their experience is improving. So I think that was the principle we started. And the way we approached in our combined business plan, this whole integration was supposed to be completed in 26 months. But our approach was to get all the partners in the war room. First time in the history, we had all our three partners and our team, Huawei, Nokia, Ericsson, working together with the single objective of delivering better experience. And that led to this 26-month plan getting completed in 12 months.
Maybe add, and really Vikram and his team has done a tremendous, exceptional job in terms of integrating and delivering the value for the shareholders, which we are on this transaction. Maybe another little recipe is, if you remember when we were doing these capital markets, you were kept asking, when are you announcing, where are you announcing? And we said, we're delaying slightly. We've agreed on terms, but we spent a lot of time with Vikram, with his team, with the CK Hutch team at the time, before closing the transaction, clearly mapping out integration plans. So it wasn't close the transaction and then try and figure out how to integrate. At least Vikram had a broad roadmap already laid out, which he was part, his team was part. The whole management of both entities were completely bought in at the moment we announced the transaction. And again, it's the work done by the team in Indosat really is tremendous.
All right. Terima kasih to Indonesia. Thank you very much. We have one more question on the screen here, but let's take one more live question. Nishit has another question. Nishit, if you could unmute your phone, please.
Yes, thank you for the opportunity. I have a question on the new tower co. Would it be open to possible acquisitions ASAP once it's formed? For example, you have an opportunity in Kuwait on the towers, which was erstwhile Zain Towers sold to IHS. So are you open to possibly leveraging that company to acquire those and expanding the portfolio and bring in efficiencies? That's the first question. And the second is one that even our clients keep asking, is that the money that you make from the tower co, any sort of special dividends or anything to be considered next year when you get that? Because I know you were going to maintain the payout. You've been very clear in this presentation, the payout won't change 40 to 60%. But what about some sweetener for the shareholders from this deal? Thank you.
So
Two parts. I think the first part I will touch on it already. The first focus is integrating and closing all our markets. This tower platform has a purpose to become the leading platform in the region, at least in the MENA region, in the near future. It's a clean vehicle with no debt, so that gives us quite a few optionality. And one, we can draw on debt to substantiate CapEx in market. We can also draw on that for further acquisitions. I think the rationale that stays true for our telco operation stays true also for the TowerCo is that in-footprint acquisition generates more value than out-of-footprint transactions. So an obvious place to look at are consolidation within the markets where the TowerCo will already operate. Again, our focus for the foreseeable future is first closing the markets. We don't want to get ahead of ourselves. It's extremely complex transaction, and you can't imagine that amount of man hours that have been spent at the group level. Again, I know it's not the forum, I want to thank the teams, but also at each opcos which are carrying the loads. It's tremendous job. Going back to your favorite questions, I was surprised that we didn't get it yet. Regarding the dividends, I need to record this sentence and just have a button to pray on it. Management has a recommendation to the board in terms of dividends. It is then a matter at the board which is discussed by the board members, which are the representative of you guys, the shareholders, and then approved at the AGM. So it's within the remit of the board to decide dividends. We can't share management recommendation to the board with the broader spectrum. It's the role of the board and the directors on the board. Today we have a guidance. We've systematically increased our dividends significantly year on year, just by the fact that we were not paying a full portion of the guidance. Now we're paying at full ratio of the guidance, plus our net profit has jumped from 800 million to probably north of 3 billion at the end of this year. So that gives a sense of just organic growth in terms of dividends. More than that, I can't say.
Okay, understood. Thank you.
Great. Thank you, Nishit. Then I don't see any more audio questions at the moment. We have a last question in the Q&A section. If there's any more, please type or raise your hand now. The question that we have here is, how can the impact on a reduced EBITDA from leaseback fees be limited if the joint venture is expected to generate 500 million in revenues, while tenancy ratio is 1x, and Ooredoo is a bigger tenant compared to Zain? Should it be close to negative 10% on EBITDA? Yes, do you want to?
Yeah, sure.
Yeah.
You haven't
No, I think we are still accurate on our EBITDA calculation that it will have minimal impact. Actually, it's positive, but it's minor amount. What we are talking about here is EBITDA after lease, and this will be disclosed country by country at the closing, the impact on the EBITDA after lease, but the regular EBITDA will have positive impact.
And maybe if I may, if I can add something on this, without talking through the numbers, just on your calculation, conceptually something that is missing is that there are also savings. So there are costs that are today borne by the OpCos, such as ground lease and security and maintenance, which are passed on to the TowerCo. So you cannot simply add the revenue of the TowerCo to reduce the cost to the OpCo.
Great.
Yeah. I was going to say also an added benefit of a TowerCo is going forward, the CapEx for the towers, for the passive is no more borne by the OpCos, it is borne by the TowerCo. So this is off our balance sheet now. So that's an added free cash flow benefit. Like we've spent 20 months on this transaction. We didn't need to do this transaction in every way, shape, or form. We weren't under pressure. We're really doing it because we strongly, it's not believe, we're convinced that this will be significantly value accretive in the medium and long term, and even in the short term.
Okay, there's one last question with regard to the accounting treatment. Will the joint venture net income be integrated into the Ooredoo Group EBITDA?
Yes.
Okay, great. That covers all the questions. Thank you very much to everybody for joining and to the panelists. From Investor Relations, our next event will be the full year results sometime middle of February. If you have any questions in the meantime, do reach out to the IR team. And, thank you very much for your continued interest. Any last remarks from?
No, thank you for joining. Thank you for your questions. As Andrea has mentioned, especially in preparation in the lead of next Capital Markets Day, if there's area of focus you want us to focus, if you can send it in advance, so we're happy to cover this area. We're trying to be as transparent and forthcoming with our investors as possible. And again, I want to thank everyone around this table and everyone outside of this table that has spent a long time closing this transaction. We're all very excited. Thank you.
And before you log out, we also appreciate your feedback in the survey that we have right when you log out of this webinar. And the last comment there in the chat, I see, give us dividends. So. Thank you very much, everyone.